Welcome back to Financial Market Insights for Traders, where we decode the chaos, make sense of the signals, and bring clarity to your investing strategy. I'm your host, Sophia. And in today's episode, we're digging into something every trader and investor wrestles with: how major news events can ripple through your portfolio, sometimes instantly. From rate hikes to geopolitical shocks, from massive IPOs to sudden inflation surges. Today, we'll break down how these events impact stocks, bonds, currencies, and commodities. More importantly, I'll walk you through what smart traders might consider doing or not doing when headlines hit hard. Let's get right into it. When the Fed talks, markets listen. Few things move markets like a Federal Reserve interest rate announcement. When the Fed raises rates, it's typically aiming to rein in inflation. But the knock-on effects across asset classes can be significant. A rate hike often triggers a broad pullback in stocks, especially in high-growth sectors like tech and biotech. These sectors depend heavily on future earnings. And when borrowing costs rise, the value of those future earnings drops. In plain terms, money gets more expensive and growth stocks get punished. Bond yields usually spike because new bonds offer better returns. That attracts capital, often pulled from equities. Meanwhile, the US dollar tends to strengthen with those rising yields. And gold? It often moves up too, acting as a safe haven when uncertainty peaks. So what's a trader to do? You might look at shifting into defensive sectors like utilities, healthcare, and consumer staples. These sectors tend to be more resilient in tighter conditions. Also, consider short duration bonds. They're less sensitive to rate hikes. And for downside protection, inverse ETFs and options can help you hedge your exposure. For deeper, real-time breakdowns of Fed impacts, don't forget to subscribe to the Crystal Ball Markets podcast. Their market update episodes are sharp and easy to digest. The impact of war or geopolitical crisis on the stock market. When war breaks out or geopolitical tensions escalate, markets don't wait. Capital flees risky regions. Supply chains get disrupted. And commodity prices, especially energy, often spike. A prime example, the 2022 Russia-Ukraine war. It sent Brent crude and natural gas soaring. European equities took a hit, while defense contractors saw big gains. The US dollar and gold? They surged as investors ran to safety. Here's the ripple effect breakdown. Equities can experience sharp volatility, especially in regions close to the conflict. Commodities like oil, gas, and agricultural goods often rise. Currencies like the Swiss franc, US dollar, and Japanese yen strengthen. Even crypto, viewed by some as digital gold, can spike, but it's volatile. So what might traders do? They may rebalance into low beta, dividend-paying stocks, or consider ETFs tied to gold, energy, or agriculture. Currency hedging becomes essential if you're exposed internationally. And if you're curious about how wars shape investor sentiment, search for podcast episodes on the impact of war on stock market for event-specific takes. Elections policy shifts. Now let's talk elections. Political transitions shake markets, not just on ideology, but because of the policy uncertainty they bring. Take green energy policies, for instance. A pro-renewable government can fuel rallies in solar and EV sectors. Meanwhile, traditional energy, banks, and healthcare might see price pressure if regulations increase. Markets usually start pricing in expectations months in advance. But surprises, a delayed result, or an unexpected winner can cause dramatic swings. So what's your move? Follow not just polls, but policy platforms. Think about sector rotation. If fiscal spending is likely to rise, look at infrastructure. If regulation is tightening, reduce exposure in those vulnerable sectors. For monthly political impact analysis, check out the April 2025 stock market outlook on crystalballmarkets.com. It's a goldmine for macro context. Big IPOs, opportunity or distraction. Uber, Airbnb, Reddit, big IPOs grab headlines. But should they grab your portfolio? IPOs usually go through 4 stages. The hype before launch, volatility right after listing, a dip during the lockup expiration, Potential stabilization and institutional accumulation. Remember, not every IPO succeeds. Even Facebook stumbled before it stabilized. Some IPOs are just overhyped and overvalued. Smart play? Wait for price discovery. Don't jump in on day one unless you're confident. If you want exposure, look into ETFs that track recent IPOs. Inflation surges. Let's talk inflation. Rising prices affect consumer behavior, business costs, and, crucially, central bank policy. High inflation forces interest rates higher, and we've already discussed what that does to stocks and bonds. But the bigger question is, how do different assets react? Consumer staples and energy stocks tend to hold up. Tech and discretionary sectors often suffer. Traditional bonds lose purchasing power. Commodities and real assets like real estate can rise. As a trader, you might consider Treasury inflation protected securities, TIPS, or rotate into commodity ETFs. And don't sleep on infrastructure plays. These often benefit from inflation linked government spending. Looking for detailed strategies? Listen for episodes tagged Investing During High Inflation. You'll find actionable insights. Tech regulation or antitrust news. Big tech is under a microscope. Whether it's the EU's Digital Services Act, the FTC scrutinizing Amazon, or global tax reforms, these headlines can hit hard and fast. When regulators come knocking, stock prices wobble, revenue streams are threatened, business models get questioned, and valuations can fall, sometimes dramatically. So, how can you protect yourself? Avoid overconcentration in any single tech stock. Consider put options during earnings or legislative cycles. And diversify across tech themes, AI, cybersecurity, fintech, so you're not overexposed to regulatory risks in just one area. Global recession fears. Recession signals usually start in the bond market. When the yield curve inverts, it's often a red flag. Equity markets begin correcting, and capital rotates into safety. Sectors to watch. Recession sensitive. Industrials, retail, energy, financials. Recession resilient. Healthcare, utilities, consumer staples, and yes, gold. Your tactical response? Focus on quality. Dividend paying blue chips, short term treasuries, and cash positions provide flexibility and downside protection. If you want more prep, look for content on investing during a recession to get defensive strategies mapped out. Currency devaluation or sovereign debt crisis. These are big shocks, especially in emerging markets. When countries like Argentina or Turkey face currency collapse or debt default, the effects are global. Capital exits fast. Bond yields surge. Currency exchange rates go haywire. Investors panic. What can you do? Use ETFs that hedge currency risk. Reevaluate your emerging market exposure. Follow macro focused podcasts that track currency crisis impact on global markets for real time strategies. Timely reactions, not knee jerks. Here's the takeaway: don't panic. Think in terms of probabilities and scenarios. The smartest investors ask, what are the first order effects of this news? What might the market overreact or underreact to? How can I prepare instead of react? Your playbook should include diversification to cushion shocks, risk management tools like stop losses and hedges, liquidity to seize opportunities when they arise, and consistent learning because markets evolve. Don't chase headlines. Anticipate narratives. To help you stay sharp, I highly recommend the Crystal Ball Markets podcast. Whether you're a day trader or a long-term investor, it breaks down the noise into useful moves. And if you want more strategy and market forecasts, visit the crystalballmarkets.com blog. It's loaded with analysis to help you navigate volatile markets with confidence. That's all for today's episode of Financial Market Insights for Traders. If you found this useful, be sure to subscribe, rate, and share it with fellow investors who want to stop reacting and start preparing. Until next time, stay informed, stay nimble, and never invest in the dark.